Hey guys, welcome back to another episode of The Trading Edge. If this is your first time joining me, my name is Akil Stokes. I am a professional currency trader as well as a trading coach over at tier1trading.com. I am also the host of one of the fastest growing trading related podcasts out there, cleverly titled The Trading Coach Podcast. Today I want to give you guys a very special episode of The Trading Edge, mainly because I messed up yesterday. The Trading Edge is a video that Jason Greystone and myself do for our Tier 1 trading members on a daily basis. And yesterday I recorded a video looking at some longer term positions, mainly because today is Good Friday. Banks are closed. It is the Easter weekend. Happy Easter to you guys, by the way. So we kind of knew that there wasn't going to be much activity in the markets today, so we'd rather set you up for next week. At the very end of that video, I talked about my equity curve, shared a little bit about my quarterly review and how my trading has gone. However, in the post-editing process, I forgot to include the visuals. Maybe something to do with me being awake at 2:30 that morning for no good reason. The mind was spinning with all types of stuff of new training courses and new podcast episodes, and I don't know what was going through my mind, but I was up early and I was probably at that point where my brain had retired for the day. So what I want to do in this video is something that's going to be a little bit different. Instead of showing you trading opportunities, because we do that all the time, and again, there's nothing new that's happening in the market that I can follow up on from yesterday's video, I wanted to share two things. One, I wanted to share with you some of my thoughts on my quarterly review. I did my quarterly review of my trading, and what quarterly review means is how the 3 months of trading went. So I crunched the numbers, looked at the stats, and this is something that I do on a regular basis just to make sure my trading is on track and see if there's any adjustments that need to be made for the rest of the year, or at least for the next quarter. So I'm going to share with you a little bit about that, a little bit of the conclusions I came to after that. But I also want to share with you a pretty interesting opportunity is not the word, a pretty interesting occurrence in the market. We had a great conversation in the live trading room this Wednesday about a very specific trading opportunity that was on the horizon and how to handle it. And well, I'll let you guys see the video, but it turned out to be one of the most painful trades / non-trades in my trading career. Which is good because when I have pain, you guys love the video because you can relate. So I think you guys will enjoy it. So we're going to check that clip out first, and then we'll come back and I'll update you on it. And then I'll take you through a little bit of my first quarter of 2018 review. It's not going to be one of those instances where you have to choose one over the other. I will be able to enter both. This is probably going to be, for you guys that have ever experienced this situation, this is probably the most gut-wrenching situation that you can have in trading. Who can tell me why? Who can tell me if they've ever been in this situation? Back-to-back pattern formations with the second entry being essentially right at the stop of your other one. Who can guess why this is gut-wrenching? Why it will twist your insides and squeeze them. Doesn't the B leg of the first cipher close below the 618? Not for me, no. Check your data though. If it did, our pattern recognition software would not have recognized it. But check your data. New Zealand data is going to be a little bit iffy. But yeah, it's one of those things where you have to get stopped out and immediately enter a trade again. So imagine like you're a boxer and you go into the ring, Mike Tyson punches you in the face. Boom, you're knocked out. And then you've got to get right back in the ring against Mike Tyson again. Who wants to get back in that ring? It's tough. because I'm not sure if we talked about it here or if it was in the podcast I did yesterday, but in general, as humans, as people, we tend to hold on to things. We tend to base our future expectations off of the most recent results, right? Recency bias. You guys ever heard of that? And that's even more dominant with painful situations. We hold on to pain more than we hold on to pleasure, right? You think about different times in your life, we hold on to a lot of more painful situations than we do the pleasureful ones. And you see that even more in trading. People are like, okay, winning trade, that was good. Oh, that loser from 2 years ago. Because pain affects us more than pleasure in general. So to get stopped out of a trade is a painful situation to you guys that have emotions and that care. Once you become numb like me and you don't care, it doesn't matter anymore. But for you guys that still have your trading emotions, that still feel a little bit of a pinch every time you're stopped out, right? The first thought that probably enters your mind is, why the heck would I enter again? It's literally 5 pips after I just got stopped out. And especially if you get stopped out on like some big high bearish momentum candle, that's just steam rolling down, right? Don't catch the falling knife, right? Why would you do that? And it's fresh in your head. But guess what you got to do, guys? Guess what you have to do if you want to be a consistently profitable trader? You got to take them. You have to. You must. You may not want to, but you have to. And this is where valuing the process has to be much more important to you than valuing the outcome. In your brain, when you think about pain and pleasure, you have to associate pleasure with following your plan and pain with not following your plan. The pain of not following your trading plan, so skipping the trade purposely, has to outweigh the pain of taking a potential loss, a second potential loss. It has to. That's the only way it's going to work. But these situations stink. Fall off the horse and get right back on. Ooh. But you know what's worse? We talked about this earlier. You know what's worse? Know what I would hate? I would hate to see price action go down, stop me out of my first cipher. And who knows, it could hit targets on the first cipher and still rally down and hit the second one. But let's say stop me out immediately. Big old bear candle, right? Stop me out immediately on my first trade. I get scared. I don't take the second trade. The second trade rallies up, wins. And now not only did I take a loss on the first trade, but now I missed profits that would have made up for that loss on the second trade. That's when the computer would go out the window. But it's all about how we make these associations. That's all it's about. I mean, think about it like this. Is there any reason to assume? Yeah, we can't say kick the cat anymore because like PETA's listening and they don't necessarily like that. Animal violence. We're so sensitive in this world. So that's why you notice I haven't been saying kick the cat. Now I've just been tossing things out windows. But next thing you know, they're going to say, Windows and computers have feelings too, Akil. And then we won't be able to do that either. And I'll have to come back and be like, when I get angry, I gently tap my computer on the back and say, it's okay. And I give it a big hug, a big old love hug. We're getting soft, man. But back to the point. Does the outcome of the first trade have anything to do with the outcome of the second trade? I appreciate you guys putting up with my ridiculousness. It takes a certain type of crazy to spend 3 hours a day with me. But no, the outcome of the first trade doesn't affect the outcome of the second trade. We just create a reason for it to, out of fear. Because if you think about it, if you put a positive thought on it, shouldn't we, right? Based on probabilities, right? How many of you guys have tested the cipher pattern? Based on the probs, what is your, shoot me in the win percentage that you guys got? And make sure it's a good win percentage, because if it's not, this rant won't work. No, I'm just kidding. But shoot me in a win percentage of what you guys got from ciphers. Just in general. Doesn't have to be your best pair, doesn't have to be your worst pair. 82%, golly. 72, I see 77%. Yeah, a lot of Aussie, Canada, and New Zealand dollar testing. 82 is really good. If it was anyone else aside from Gabrielle, I would question that result. But we actually had Darren had 80% when he first tested it. But all right, so we're seeing like let's just say 70%, right? So pure probability, right? Because we're working off the idea that the first trade lost, so we're so scared and we're so fearful that we assume the second trade is going to lose as well. If we have a 70%, if this pattern formation has a 70% chance of winning, it wins 7 out of every 10 trades, right? It's safe to say that it wins more than it loses. Therefore, if we have 2 trades and 1 loses, shouldn't the probability be that the next one is going to win? Now, I know it's not like that in real life because the numbers are so rangy, but in general. All right, so I apologize for cutting the conversation off, but I like keeping these YouTube videos on the shorter side, especially knowing that I have some other things I want to get to. But actually, you know what? I'll do this. I have a new episode of the Trading Coach podcast coming out on Monday. So what I'll do is I'll include a portion of that rant and, of course, the part that I didn't share with you in Monday's episode. There we go, Kill. Perfect. Kill 2 birds with 1 stone. So keep an eye out for it. Should be released Monday at midnight at Monday. You can catch the rest of the rant there. I think we go on to talk about process over outcome and a whole bunch of trading psychology stuff. So it'll be a good lesson as always. But on the screen in front of you is that New Zealand dollar trade. And yes, you can see it already. 2 things happen. 3 things happen. First, the initial cipher, which was right in here, was filled. Secondly, that initial cipher, which was here, was stopped out. Thirdly, I'm going to bring on my Enigma software real quick, and let's just take off some of the clutter. There we go. Thirdly, you can see that the bigger cipher looked like it was filled. Unfortunately, I was not. Now, this has been interesting because we have a handful of traders. We just had a lesson in one of our Q&A sessions on front-running orders and the importance of doing some. And this was a perfect example. Well, maybe not a perfect example. I did front run my orders and I still didn't get filled. But speaking to a handful of traders that did get filled, they were very excited yesterday. And as I was all rah-rah and cheering with them, I checked my charts and forgot that I didn't actually get filled the trade. So this wasn't the worst case scenario. The worst case scenario is that both trades would have lost. I think I took a 30-something pip loss in the first one. The secondary cipher pattern, which was a lot bigger, would have been even more. So that would have been the worst case scenario. But this is, I would say, the most frustrating scenario because the whole premise was that, hey, I take a loss on the first one, and then the second one, if it wins, it'll make up for it. We had the whole conversation about, win rate and all that good stuff. Well, I took a loss on the first one. The second one literally came 2 pips before my entries, looked at me in the face, smiled at me, winked, turned around, and ran the profits that would have made up for the first loss. Frustrating. And guess what? There's nothing you can do about it. So frustrating but not upset because I followed my plan, but nothing you can do about it. Now, I know what many of you guys are thinking, and if you're thinking it, you haven't heard enough of my content. You're thinking, Akil, well, in hindsight, why didn't you just move your orders up a little bit? Well, of course, in hindsight, we always would have done that. Guess what? In hindsight, I would have moved my stops for the first pattern back about 5 pips as well, so I would have got stopped out, right? Hindsight is a beautiful thing because we're all winners in hindsight, right? 100% accuracy. But another thing is making adjustments, and this is a topic that comes up a lot. This is actually a topic that we're going to talk about when I go over the stats for the first quarter. But you say, Akil, you missed this trade by 3 pips, right? The cipher entry was at 71.85. My orders were at 71.87. Price came to about 71.88. So just missed probably about 3 pips once you take the spread into account. Why don't you start front running your orders even more? So instead of front running by 2 pips, you front run by 5 pips. So the next time this happens, you will be in the trade. And it's a good thought process. The problem is we want to be aware of the repercussions and the reality of trading, right? So the repercussions, every time we front run an order, meaning every time we put an entry above where the completion should be at, we're taking away from our potential profit and we're adding to our potential risk. And what that is doing is it's slowly changing your expectancy. And for you guys that are newer, your expectancy is basically, how can I put this in simple terms as possible? Your expectancy is basically what tells you whether your system is profitable or not. It has to do with your win percentage, your average win, your average loss, and all of those numbers, putting them together to see if you are above 0 or how much above 1 you are. And as you do that, you slowly shift the scales of that risk reward. And you don't necessarily change your win percentage to the greater. And you can very easily, maybe not in this particular situation, but you can very easily turn a winning system into a break even or a losing system by adding or subtracting a little bit of pips here or there. But beyond that is the fact that it becomes addictive. And one of my best trading friends, I had this happen to him, where originally you front run by 2 pips. I'm going to draw this on right here, right? And then what happens is, and let's just draw up the risk reward. This will be interesting. The cipher is a pattern that often has a inverse risk reward. So this will be even better here to give you guys kind of a visual representation of this. What do I want to do here? Price is on, risk reward. There we go. So let's say our stop is down here, and our entry is right here, 77 or 87. Excuse me. This may be a longer video than I anticipated. It's Good Friday, so it's good we get a nice video out. Hopefully I can get it out to you guys in time. So here's our initial risk reward. You can see it's a little bit below 1-to-1, right? You see this little line here that says T1 0.9. So it's a little bit below 1-to-1 if you enter at the right mark. Now remember, we're front running, so we're changing that a little bit already in the favor of giving us less reward and more risk. Now, let's say we missed this one time, like, oh man, we missed by 1 pip. Next time I'm going to front run by 5. What that does is it now moves my entry up to here. And you can see that is slowly going to, once again, reduce my reward and increase my risk. And here's the problem. At some point in time, no matter where your entries are, no matter what strategy you're trading, no matter what type of trades you're taking, there's going to be a time in the market where price comes right before your entry and reverses at some point. So you're always going to be chasing this because as you move your entries here, right, there's the next pattern, let's say, is going to do that. It's going to come a tick before it and then reverse. And he's like, oh, well, I got to front run by even more. And before you know it, right, you're in a habit of consistently reducing your risk or reducing your reward, excuse me, and consistently increasing your risk without necessarily increasing your win percentage. This is all good if you're winning 80%, 90% of the time consistently, or if the changes that you're making is allowing you to win at a higher win percentage, because the higher the win percentage you have, the less your risk reward matters, to be honest with you. But you're not necessarily doing that. You're probably trading at the same win percentage, or at least not shifting it enough to make a big difference. And you can see that because you're taking on more risk each and every time, in order to stay profitable or become more profitable, you have to win more. And people don't think about that. They think about what's going to make me feel good right now. That last trade is stuck in their mind. What would have allowed me to not experience that pain? I'll make that quick fix. I won't test it or do any of the stuff that professionals do. I will just change it. And then they slowly find themselves in a boat where they're consistently losing money and they're asking themselves why. I see this all the time, guys. I see it all the time, including myself personally. Not now, but back in the day when I was a mistake maker, right? So good example right here. You get to share in some of my pain as far as missing the opportunity. Just missed out on 50 pips. That sucks. But I'm happy for the traders that made profit, except for you guys on the chat this morning who kept bringing this pair up, right? We had a handful of traders on Good Friday in the chat room talking about how excited they were about the New Zealand dollar, knowing I just missed. I hate you guys. Just kidding, of course, but a little bit serious there. But anyway, let's dig into the numbers a little bit. I'll make this quick since I'm rambling. But this is what I want to show you the other day. I want to show you the equity curve. And in the last video, in the last episode, was it episode 40 of the Trading Edge? Yep, episode 49, excuse me. We talked a little bit about the decline in volatility in the market and how recently the markets have kind of been less active. And it's kind of early for that. Usually that doesn't happen until about May. But you can see the difference in the equity curve as well. In the beginning of the equity curve, we had bigger swings, right? Bigger extensions up, bigger pullbacks down, bigger extensions up, bigger pullbacks down, as there was more profit to kind of be extracted from the market and also more risk because there was more volatility going on. The average ranges were bigger. Now that the volatility has kind of mellowed out a little bit, we're still trending in the right direction. You can still see that we're creating higher highs and lower highs on the equity curve. However, you can see the momentum, right? For you guys that took the foundation course, the momentum is starting to slow up a little bit. Now, this isn't a bad thing. It's different. We had a few traders teasing the other day about, one of the techniques I teach is a simple pattern formation called a rising wedge or a rising channel. And it's usually an exhaustion pattern, meaning that once the price action loses momentum, or as momentum starts to slow, you typically see some type of retracement, some type of relief out of that. And they were teasing, hey, Kill, your equity curve is going to do the same thing. And it may, who knows? I am hitting at a higher rate than I'm used to, or not, well, at the higher end of my rate, which we'll talk about in a little bit. So that could happen, but there's no real need to fear. It's just we're taking what the market gives us. That's all we're doing. And because the market is giving us this, this is how the equity curve looks. Now, I just mentioned that I'm hitting at a higher rate. One thing I noticed, or for you guys that are new, typically I am about a 55% trader. We can go in a whole conversation about that, or you can listen to one of my latest podcast episodes called Who Gives a F About Your Win Percentage. Of course, the F is replaced by little asterisks because I want to keep it clean. But typically, I'm a 55% trader. When I'm doing poorly, I'm hitting at about 45%. When I'm doing excellent, I'm hitting at about 65%. And that's what I'm hitting at right now. Now, the biggest difference is I haven't taken a lot of trades this year, and I haven't dug into that yet. But it's interesting. I've only taken about 31 trades this entire year. Now, a lot of that has to do with taking the month of January off to set up the new Tier 1 trading website. And, you guys know we recorded 5 brand new courses in about a month worth of time. So I didn't really trade January. That is, we need to take that into account. But also, I think a lot of it has to do with me just focusing on quality over quantity. I come in each and every day and I try to find not just good trades anymore, but the best trades. And I've really filtered out a lot of those iffy trades, mainly because my number one goal is conservation of capital, even more so now. And it also helps with having a great community of traders around me to kind of keep eyes and share ideas. I know many of you guys here on the Tier 1 trading platform, you guys have shot ideas in that I wasn't necessarily looking at, and those turned into very good trades. So it's really cool to have like-minded individuals of a very quality level to trade with. So that's helped me out. But I do expect to revert to the mean somewhat. I don't think it'll be awesome if I did. I don't expect to hold 65% the entire year. I don't expect stuff until I actually do it. So there is going to be a drawdown coming. You see one there at the beginning of the year. I think one will come at some point, maybe possibly the summer. That's when things get slow. But it would not shock me if I went back down into the 50s. And I'm mentally prepared for that, so I don't freak out. I actually spoke to a trader today on Twitter who's doing it. He showed me his equity curve, and he took a massive drawdown in his trading, but now he's fighting his way out of it. And he was sharing some advice to other traders about how, you make sure you don't do anything wrong. You stick to your guns, and you just grit your teeth and fight it out. And that's what trading is, man. It's a dogfight every single day. It's not this lavish life of luxury that many portray it to be. It's, put your hard hat on, put your, tighten up your bootstraps, and then you go in and you grind it out each and every day. So some other notes that I know I mentioned earlier in the year about T2s, target twos not being where I wanted them to be. Recently, we had a few trades that had some massive target twos filled, including that dollar-yen trade that I was sitting in for a month and a half. It never expanded to the place that I wanted it to, but I was still able to collect a couple hundred pips on the second half of that position, which helped that total out. So target twos are outperforming target ones, which is how it should be. So that is no longer a red flag or a yellow flag. And then also, I found this to be interesting. I always keep track of my win percentage and profitability per pair and per strategy. And for you guys, I simplified it with, just the three basic advanced pattern formations that I trade: bats, Gartley, ciphers, and I have other, which is all of my structure trading and trend continuation and breakout stuff. So you can see that the cipher, 83%. So it's funny, I was just talking to a trader in the clip I showed you saying that 83%, that sounds a little bit high. I don't know if you want to trust that number. Then lo and behold, I'm 83% somehow this year as well. So I guess I got to eat my words for the positive. And for you guys that are asking, Keel, how come you didn't know that? I really don't care about my numbers. I care about the process. So I don't actually know what I'm doing as far as like wins, losses, and all that fun stuff. I don't even know how much I'm up pip-wise, aside from knowing if I'm doing good or bad, until I actually crunch the numbers. I really don't care. I am that locked in to the process of trading because I know if I'm doing what I'm supposed to do, the results will be there. And this is a perfect example. So Cypher stood out at 83%. You can see other, which is 50%. Many of you may think that's low. That's actually, all these numbers are exactly where I would think they would be at. Bad is typically around 55 for me. Gartley is typically around 60 for me. Ciphers are typically around 70, so that's out shooting a little bit. And then all my other structure trading is about 50-50 historically for me. So no red flags there. That's good. By pair, this is interesting. You see some pairs, take the numbers for what they are. Remember, I've only taken 31 trades, so like stuff like the euro dollar, it says 100% accuracy, but I've only taken, or not the euro dollar, the dollar yen, for example, I've only taken a single trade on the dollar yen and it won. So that number doesn't really mean too much this early in the year. But one number is interesting. The Aussie dollar and pound dollar, right? You see they're both zero. Well, actually, the Aussie dollar is nothing. I haven't taken an Aussie dollar trade. The pound dollar is zero. I am 0 for 5 on the cable, guys. I am 0 for 5 on the cable for negative 525 pips. That stands out a lot. Everything else is positive. Euro dollar plus 139, euro yen 137, dollar yen 361, Canada 233, so forth and so on. This is the only pair that I'm actually negative on, and as you can see, I'm negative by a bit. So all of my losses, essentially, at least the majority of my losses, came on this pair, which is concerning. Now, the question that I got from a few traders when I shared this on our community chat this morning was, well, do you stop trading it? And that is a valid question. And my answer is no. It is way too early to stop. It's only been 3 months. And again, really 2 months for me since I didn't do January. And it could easily be a bad stretch. For you guys that have performed back testing, you've seen good and bad stretches and know what that's about. It's way too early, but I do want to keep an eye on it. And I'll leave you with this. I had a similar situation 5 6 years ago with the Gartley pattern, where it wasn't this bad, but the Gartley pattern was essentially bleeding my account. I was doing great everywhere else, and then the Gartley pattern, I was winning at like 20%, and it was losing money. And I remember I had the same debate. This was in June, however, and I was like, should I just dump this thing? Because obviously, if I want to make the numbers look as good as possible, if I, taking 526 pips of losses away adds 526 pips of profit, essentially, that's a big flip. And you need to give your system time. You don't want to be too quick to jump system. Many of you guys have system hopped before. You can do the same thing with pairs in your portfolio. You don't want to system hop. And here's what happened with that Gartley formation. It beat my behind for the first 6 months of that trading year, and I stuck with it. I said, I'm going to give it to the rest of the year because I wasn't doing anything wrong. I reviewed my stuff. I was taking good trades. The market just wasn't meant to be for Gartleys, and that happens sometimes. And what happened throughout the last 6 months of that year was the Gartley caught fire. There's a YouTube video about it somewhere. I've got like 500, 600 videos on YouTube, so I have no idea where to find it at, but it's one of those old videos back when I was with the other company. But I remember they caught fire, and Gartley's basically carried the rest of my trading year. And we ended up about 60% right where I thought I would. So they were winning and winning and winning, probably at about like an 80% clip for the rest of the year, bringing me lots of profit. And I remember sitting back in December, right, while counting a big bag of money. Always want to say that. I remember looking back in September doing my full year review, and I'm like, man, I'm glad I stuck with it. Because if I would have ditched it, I would have sabotaged my trading. So I'm not cutting pound dollar from my trading portfolio. The next time I load up a chart, I will give it a very angry look. I will look at it very aggressively and very angry, but I'm going to give it time. It's been 2 months of trading for me, and that's not nearly enough time to make a decision, especially with a pair that has been in my portfolio since the beginning. All right, gang, so I hope you guys enjoyed this video, and once again, happy Easter to both you and your family. I'll be heading up to New York City per tradition to enjoy a brunch with mine, and I hope you guys do the same. Now, before you leave, I have one more request, and I know I ask it each and every week, but it is very, very, very important to me. Like, share, and subscribe if you're new. That is the best thing that you can do to help me out. Not only to this YouTube channel, but to my podcast as well. The Trading Coach podcast has become one of the fastest growing podcasts, the newer podcast, I should say, as far as Forex and trading and investing goes. And I want to keep that momentum going. So if you like podcasts, check it out. It's available everywhere, but like it, subscribe it, leave me a rating, especially on iTunes and Stitcher. That is a massive help, and hopefully we can keep growing this thing bigger and bigger and bigger and help more and more traders out there. So if you can do that, I'll be back next week for another Trading Edge video, or I guess Tier 1 members, I'll be back next week almost every day. YouTube members, I'll be back next weekend, hopefully, for another episode. And until next time, plan your trade, trade your plan. Take care.